Hello everyone, this is Ted Bauman, editor of the Bauman Letter from Banyan Publishing. A couple of weeks ago I released a video where I talked about my concern that investors might be drawn into over-investing in the stock market in 2019 by the fact that the Federal Reserve has announced its intention to stop its reduction, or rather increase, of interest rates. Now, my concern hasn't gone away, and in fact I've been thinking about this a little bit more. And what I'd like to do is kind of describe why I think this is a potentially, not necessarily a dangerous situation, but one that I think investors need to be aware of, particularly in selecting the kinds of companies that you want to invest in. Now, one time years ago, people described the actions of the Federal Reserve as being a put under the stock market. Now, a put basically, as you know, is an option investment where you expect the price of an asset to fall. And essentially, the notion that the Federal Reserve was engaging in a put under the stock market in the 1990s and 2000s was intended to express the idea that the stock market was being propped up by the behavior of the Federal Reserve, specifically in terms of setting interest rates. That by keeping interest rates unusually low, the Federal Reserve was, in a sense, trying to prop up the stock market. Now, the stock market is not supposed to be one of the policy mandates of the Federal Reserve. The Federal Reserve's job is to maintain full employment and to manage inflation, to prevent it from getting out of hand. The Federal Reserve's job does not include keeping stock prices elevated. Nevertheless, it does appear to many people that in 2019, by signaling its intention to slow down the pace of increase of interest rates, and more importantly, perhaps, by announcing that it's going to slow down its sale into the market of the many junk securities it purchased in the aftermath of the 2008-2009 financial crisis, that the Federal Reserve is again buying a put, if you like, on the U.S. stock market. Now, personally, I don't feel that the Fed is doing this intentionally. I don't think that the Fed is deliberately trying to overinflate stock prices by signaling its intention to slow down on interest rate increases. Instead, I think what's happened is that the underlying level of inflation that we can expect in an economy that has full employment like ours right now is a lot lower than it used to be for a variety of technical reasons. But what does concern me more is the notion that the Federal Reserve is slowing down its sale of these assets. Now, to understand why that would concern me, think about what those assets actually are. In the immediate aftermath of the failure of a couple of major banks in the United States at the end of 2008, the Federal Reserve started a program where it bought up what it called troubled assets. Now, these troubled assets were essentially, if you like, securities that had been bought by large banking houses like Goldman Sachs and Morgan Stanley and others, that were based on derivatives that were really a bet on the performance of the U.S. mortgage market. And because that mortgage market didn't do well, because it began to decline in quality over 2007 and 2008, the value of those securities, which were based on these mortgages, began to decline. And by buying these securities, essentially what the Federal Reserve did was to take them off the balance sheets of the major banks. Now, banks are generally limited in their activity by the health of their balance sheet. If a bank has too many liabilities, that reduces the amount of reserves the bank has. And the level of reserves is what determines how much lending a bank can do. And the less lending a bank does, the less money it makes, because, of course, it reaps part of its income from the interest and fees that come with issuing loans and securities and other things. So in a sense, the Federal Reserve, by buying these troubled assets out of the market, was giving U.S. banks a leg up. It was giving them an artificial avenue to dispose of assets that would otherwise have limited their ability to lend, right? Now, if you were a business and you were in a deficit situation where you didn't have enough money to fund your business, nobody would come running to your rescue. But the Fed did that because the Fed believed that this was for the good of the U.S. economy. Fast forward to 2019, and what the Fed is saying is that it still doesn't believe that the economy and the banking system is in a position to be able to handle selling these assets back into the market. So really, essentially, it's still a subsidy. So to me, as an economist, when I see an economy and a stock market that is effectively being subsidized by the Federal Reserve, by its reluctance to release these assets back into the market, that's a danger sign, because it means that valuations continue to be probably overinflated relative to what they should be, given the play of free market forces. Now, the lesson from this is not to not invest in the stock market. That's not what I'm trying to say. The lesson is you need to pick your stocks very carefully. Right now, I think that it's probably a mistake to invest primarily in index funds that track the major US indices. Instead, you need to be much more discerning. You need to look at specific sectors and specific stocks that are likely to do well, even if the Fed's put on the US stock market begins to lose some of its effect and it begins to deteriorate. That means that you need to pay attention to the recommendations that folks like me and others at Banyan Hill make, because our job is to try to identify the stocks that will survive the end of the potency, if you like, of the Fed's put. I hope that makes sense of what's going on in the US stock market these days. This is Ted Bauman signing off. And remember, besides YouTube, I have a Facebook page, Twitter accounts, and various other places where you can find information that supports the arguments and documentation that I send out in the Bauman letter and in other publications. So make sure you visit those. Thank you very much.